before we jump into the partnership formation problems, let's take a little break. You might be wondering, why am I wearing a lobster costume? This is actually my corporate tax lobster costume. Now you're even more wondering, why is he wearing his corporate tax lobster costume? Because this is partnership tax, and again, you're confused why I'm wearing a lobster costume. Well, it's something very important that I talked about on partnership formation in comparison to corporations. Now, this is indeed a partnership tax class. This is not a corporate tax class. I am not going to hold you to knowing corporate tax for this class, but it's very important you understand the distinction when it comes to some of these rules, because out in practice, this makes a huge difference. So this is my corporate tax lobster costume. Let me explain. Many practitioners and academics, they equate corporate tax to that of a lobster pot. And I'm not talking about a lobster pot like a boiling pot of lobsters. For those of you up in the Northeast, you know what I'm talking about. I'm talking about a lobster trap. If you ever go online, look at a lobster trap, and you'll see that just like corporate tax, it's easy to enter, difficult to live in because there's other lobsters in there poking around, and painful to get out of. Very, very, very difficult to get out of. Corporate tax has these characteristics because on formation, it's very easy for no tax consequences to take place. Difficult to live in is double taxation during operations of the business, and then painful to get out of. When you take corporate tax, you'll learn that on liquidation, there's even more levels of tax when it comes to appreciated property and other items. Partnership taxation, a lot of these things are lessened or just non-existent. Like on liquidation, you can get out of a partnership potentially without paying any tax consequences on liquidation. On formation, there's one big thing, and that's what we're talking about right now, and that was stressed earlier. And that is when it comes to formation or contribution, when an investor or owner of a partnership and transfers property to a partnership in exchange for a partnership interest. Doesn't matter whether it's 99.99% of the partnership or 0.0001%. There's no difference or no reason to know the ownership percentage. The rules are the same. But in corporate tax, under Section 351, on corporate formation and contribution, the shareholders must receive together or by themselves 80% or more of the corporation, which is considered control. This is a huge difference. So I bring up this element to remind you, and the corporate tax law officer to remind you that on formation, it's a huge benefit to be a partnership. Tax is a partnership, not tax as a corporation, especially if you're going to have people join later on, so they can get that benefit of no tax on contribution of property. Because if it's a corporation and they don't get at least 80% or more, or they don't do it together with the other owners, transfer property together, then they're going to have to pay tax on property, appreciated property, or they won't be able, or other issues on the transfer of property, and it's a lot better to be in a partnership in that situation. And later on in the semester, we'll look at liquidation and other events, and keep that in mind. Again, that in practice, it makes a big difference whether you're a corporation or a partnership, and a lot of times being a partnership makes a huge difference, a benefit. It's very beneficial to be a partnership. All right, so go ahead, and now let's look at the formation problems, going over the rules we just learned, and again, throughout the semester, keep this in mind about corporations versus partnerships.